Good evening. Welcome to the big question on NDTV Profit. I'm Vikram Oza. Now, with the union budget just around the corner, the government has this familiar but rather crucial choice. Should it play safe, or is this that moment to do more? You know, when we talk about more, it's about big ticket reforms, about big spends as well. But then on one side, the buzz that we are picking up is suggesting that corporate India and the markets are calling for more stability right now. They want predictable policies, they want steady reforms, and yes, they want fiscal discipline. Meaning they don't, they hope that the finance minister is not going to spend more than we earn. It's a budget that reassures investors and it keeps India's economic credibility intact. That's the kind of budget that perhaps the markets would want and perhaps India Inc. would want. On the other hand, there are growing questions about demand in India. So household spending remains rather uneven. The middle class is definitely feeling pressure. The global environment is turning tougher. And then, of course, those tariff tensions, trade tensions have been rising and they haven't let up. And growth from overseas markets can no longer be taken for granted right now. So now the question is, does caution still make sense? In these uncertain times, there are times of volatility. Does it make sense to play on the back foot a little bit? Or does playing it too safe, does it risk slowing growth at a time when India may need that domestic demand to carry more of that load, do the heavy lifting to pull us through these volatile times? Which is why we're asking that the consumption story needs to remain intact. And if that is the case, the question is not about reckless spending. It's about when you want to push, how much you want to push, which sectors you want to spend on, and how much at this point in time, which is going to determine how quickly we are going to grow. And IMF, of course, has projected a good, solid kind of growth above 7% for India. Can we reach that with the kind of budget that we present now if we decide to play it safe or if we decide to spend more? Which route do we need to take? That's the question that we are putting across to our panel, Budget 2026, spend big or stay steady. Let's discuss this with our guest. Market expert Ajay Bagga is joining us, along with Chief Economist at India Ratings, Devendra Kumar Pant is with us. And the Senior Vice President for Research at IIFL Capital, Renu Bed Pugalia, will join us shortly. Also with us is Bipin Sapra, the Partner and Indirect Tax Policy Leader at EY India. Thank you very much for joining us. Ajay, to you first. You know, we've always discussed this. Markets want stability. Would a big spend budget immediately spook the bond market? Would it spook the yields and the Indian rupee, which has been under stress? What do you think?
Yeah, definitely. Yes, the answer is yes. There is very little fiscal space. Overall, if you see the budget maths had nominal GDP growing at 10.1%. It's been growing at between 8 to 9%. So tax revenues have been constrained. The government has cut down on revenue expenditure to ensure that the fiscal maths is met. So there is very little space actually for enhancing the budget allocations from the government. So anything that increases the fiscal deficit would spook the bond markets and also the stock markets. So that will be looked at very closely. But if we want, bold growth and huge growth, then we have to think out of the box. That we are not expecting much from this budget. There'll be the usual announcement of new schemes or nomenclaturing old schemes as new schemes, and the subsidy burden will continue. There is political pressure on that front.
Yes.
So limited fiscal space, lot of political pressure, and a country which is turning into a freebie culture. I think those are the three big things that we will watch out in the budget.
So, Ajay, if the revenues are getting more constricted, if you're talking about tax revenues, we have the GST 2.0 reforms. If that is going to be one kind of pressure, then you're saying a lot of the spends are going towards welfare schemes. Then what happens with the kind of fiscal caution that we are exercising? Does it need to come at the cost of domestic demand support? This is the time that is required, especially when consumption in the middle of the pyramid remains rather uneven.
Absolutely, and urban consumption has still not picked up. Rural consumption is still strong. but urban hasn't. And clearly, 3% of GDP in terms of infra spend is welcome, but there are too many stalled projects. You need those projects to be energized so that the country's GDP benefits from that multiplier coming through. Ideally, if you're looking at a China kind of growth, what China did over 2000 to 2020, you need to up the GDP investment to GDP ratio to about 45%. That's the kind of leeway that you need. You need reforms of the scale of a 1991. The best, if you ask me, three, four very big things. You need to privatize most of the government holdings and open up FDI on the automatic route 100% in most of the sectors. Agriculture is the biggest drag on the economy, 60% odd people dependent and contributing 15-16% of the GDP. That's the big drag. So if you can urbanize and get these into global supply chains, uh, creation of jobs, I would say move the Manrega money into MSME creation of jobs, link it directly to job creation rather than this phantom infra creation, which has just not happened. It's been money down the drain with nothing of public works being created by Manrega. Rather than that, I would say put that money with MSMEs and give it off as a grant rather than this. And, we are very kind to the politicians, but nobody has the guts to tax agriculture. Nobody has the guts to reform the huge subsidy burden that the state faces. And government last year talked about reducing debt. So let's see, where do they get the money to reduce the debt? I think those will be the big questions.
There are many big questions around the budget. Mr. Pant, how many of the suggestions that Ajay Bagga is making do you agree with at a time that China has to kind of, if we are going to follow that kind of growth pattern, Ajay Bagga also alluded to that, then how are we going to do it? Because China is facing huge tariffs from the US. There could be a lot of dumping that would happen in India. In that kind of environment, if private capex has to pick up, where is the space for private capex right now if demand doesn't exist, if urban consumption hasn't picked up the way it should?
Vikram, I agree with most of the things which Mr. Wagga has said, but I have a different take on this. Simple one thing, we are too fascinated about comparing India with China, and we should stop that. The simple reason is Chinese Communist Party doesn't have to go and face election every 5 years. So there is a big political economy, and I'm not a political analyst, so I'll not go into that. So this is one thing which is very different between India and China. If I go back early 2000 when India-China comparison was very common, and we looked at the data at that point of time, India is an efficient user of capital compared to the China. If we can grow at 7.5% with 32% kind odd of growth rate, so this tells us we are an efficient user of capital, whereas the China, when it was growing at 8 to 9%, it used to have the investment rate closer to 40%. The second point is, if we look at today, the kind of environment, global environment, which China had when they had the leapfrog or they jumped in the faster growth trajectory, that kind of global environment is not present today. If you look at the period when India also had grown, whether you look at the old 2004-5 base year or 2011-12 base year for the GDP, the best years for Indian economic growth were from 2003 to 2010, whichever base year you take. And that was the time when Indian exports in dollar term, which is a proxy for the volume, were growing at close to 20%.
True.
Whereas right now, we don't see that kind of growth.
That's true.
Look at the any economic. Just give me one moment. If you look at any economic growth pattern, whether the newly industrialized economies, the East Asian and all, no economy is able to grow more than 7.5% consistently without support from the global demand. So that way, that India was and always remain a domestic demand story, and we have to see how can we boost consumption demand.
Correct. So if we have to boost consumption demand, Renu Baid is joining us right now. Good to have you with us. In this kind of constrained fiscal environment, which policy lever do you think we should be hitting on first to sustain our kind of growth? Is it direct relief for consumers? Do we have to ensure that capex, especially when you talk about infrastructure, that happens? Or do we think we have to preserve our fiscal stability to attract that long-term investment?
Well, I think eventually, if one has to drive demand and consumption, there has to be money in the hands of people. And the more sustainable way is to ensure there is employment and there's job creation. Nothing better than investment in infrastructure and driving private investments. So I think government is doing quite its bit in terms of maintaining momentum on the government spending. If we can sharpen up spending in certain sectors which are more which helps in creating better job opportunities, be it the road, urban infra, transportation, water. Power is one sector where investments have been significantly lagging over the last decade. So if power reforms go through, that could be one sector which can bring in significant investments in the power distribution space and create employment. So these kind of opportunities are there, and this really doesn't need much fiscal space there. So government can manage it. They can have private sector participation on a PPP basis and drive investments. So while government has done its bit in terms of GST rate rationalization last year, but that is just part of the initiatives. One would need to have more credible opportunities and initiatives to drive job creation and employment in our view. So nothing better than driving investments and capex here.
So drive investments, kind of have that kind of capex push. And you don't think it's going to take too much space when it comes to our fiscal consolidation route? It's not going to hit us too hard. Bipin Sapra, do you agree? Instead of spending big, can tax reforms, especially the GST 2 kind of reforms, do you think that is going to deliver growth without hurting our fiscal math?
I'll kind of agree with that. My view is that in the changes which have happened in the last 1 year, a lot of it has come after the tariffs which happened, the threat of tariffs, the actual tariffs, and the impact which it has had on the economy. The GST 2.0 reforms which came in, which really are supposed to boost the demand, which is yet to happen. The tax revenues, at least from the GST, have gone down. I think it's a time to look at how to make our products more competitive in the global markets. Being part of the global value chains has to be our top priority to really drive what we have really been pushing forward to drive our exports, which need to grow, which we need to find areas to grow in, which are getting impacted by what is happening in US. I think EU is one area where we are strongly looking at, which should in the next couple of months and in the time to come should be the area where our exports can grow very strongly. The investment which link policies, which are the policies which need to be there to drive investment in India, and what is required to make manufacturing much more stronger. That needs to come in because today the manufacturing PMI, which we have seen is even in December, has been lowest since almost in the last couple of years. That needs to get pushed to really drive the economy, and that will be my ask in the next budget.
There's no doubt about that. And Ajay Bagga, perhaps you can weigh in, because even as we are talking about reforms, at which stage do we need to kind of push through with the state level reforms? Because yes, labor code has come in, but when it comes to land reforms, all the important ones, is this the stage when we're talking about the pressure that's coming from global uncertainties? When you're talking about a hostile environment when it comes to global trade, is this the time that we need to push through with more reforms that's going to enable more private capex? Because do you see that happening anytime soon unless we do it?
I don't see it happening. Dr. Pant said very clearly it's a political issue, a political survival issue. So, I don't see much of it happening. the government had much reduced political capital after the national elections because it didn't get a clear majority on a single party. So it was dependent on coalition partners. After Bihar, there was some space that opened up. But again, our bane is that every year, 2 or 3 very big states go for election. So you're in continuous election mode and appeasement mode, freebie mode, rather than nation building. So the government's hands are tied a lot, Vikram. So I'm keeping my opening remarks were on a utopian front. If I had a chance, I would disinvest like crazy. I would raise funds internationally. I would give 20, 30,000 acres each to Japanese, Korean, Singaporean, Dubai firms and the governments to set up many cities which are free trade zones and have a different set of rules for those free trade zones. That's what I would unleash if I had a chance. You can't touch agriculture, you can't touch most of the population. At 12% tax to GDP, the government can't do much given its interest burden, given its pension and salaries budget, and given the constraint of 2 hostile neighbors sitting on our borders. Defense expenditure has to happen. So where is the fiscal space? In that scenario, then you say, okay, RBI should step in. RBI is doing its bit. We have broken the back of inflation. With this high a real rate, you are already constraining growth. My issue with 8% nominal is very good. The economists are more learned than me. They will say, yeah, you will unleash inflation if you go faster than your capacity. My issue is we are so infrastructure deficient.
Yes.
100 kilometers from Bombay, you still don't have electricity, you don't have running water in hamlets. That is the kind of build out that you need. You can put 10% of GDP on infrastructure. I would say if you have to borrow from abroad, create those vehicles. Small countries are raising funds abroad. You're sitting with $700 billion in FX reserves, earning 3-4%. Those should be converted into a sovereign wealth fund. And that should be leveraged out to build out infrastructure. Again, I'm saying these are utopian things. Nobody has the guts to do it. Agriculture, you can't touch.
Yes.
The poor in agriculture anyways won't come to the 12 lakh thing.
True.
It's the kulaks. It's the capitalist farmers who are grabbing all the subsidies, who are the politicians also, who are the money lenders in the villages, who cause the MFI crisis from time to time. Those also we are not able to touch. So, these are big constraints.
They are big constraints. So the question is now, are the government's options getting more limited? Renu Pugalia, we've seen so many budgets come and go. When you talk about the kind of tools that the government has, do you think that we are running short now? Because we have to boost consumption. In a way, we are talking about building infrastructure. Ajay Bagga is laying the exact areas where we need to have that kind of reform push. But he says we are constrained. How are we going to get past this? Because it's not like industry doesn't see the importance of capex to be able to drive growth, but then demand has to grow. And for that, wage growth needs to happen. And for that, the opportunities have to be created, which is something that is not happening right now. You'd agree?
Well, government is doing its bit. You need to accelerate a bit. But there's one big pool of capital which is very well available in the country is the private sector. If you compare with the last cycle, most of the private sector today is deleveraged. There is not much of leverage. And they are cash rich. So all they need is a much more favorable and inducive capital deployment policies which can be slightly more innovative to help them put in money either on the manufacturing side, which will have its own snowball effect in terms of job creation. So I think if we see over the last 5 years, the entire PLI or the incentive scheme to drive investments in the electronics value chain, to drive investments in newer segments like OSAT are all labor intensive, EMS. So but whether people realize or not, it has been very helpful to create job creation and also new growth opportunities. So government needs to be slightly more innovative to think of ways to plow back funds from the private sector in manufacturing, in infrastructure on PPP basis, the way we have seen in the railway segment, rolling stock, projects on the loco side with Siemens on PPP. Those kind of opportunities need to be plowed back so that we are able to use the domestic funds which are already available in the country
Yes.
and use the equity which is there on the books without really going big on leverage and bring it back in the capital conversion cycle and have a snowball effect on the capital formation cycle back in the nation. So I think private sector investments is very important and it has visibly slowed down in the last 12, 18 months.
Yes, it has.
So this is one segment where government needs to address through right policy initiatives and incentives to get the investment back in the core sector, in new age sectors,
Yes.
and get job creation back.
So, in terms of the inducing power that the government has to get state governments on board as well, as much as a political risk it might be, Dr. Pant, how crucial is deregulation right now? And what is the bigger long-term risk? Spending a bit more now or not spending when the economy actually needs it?
Look, it's a catch-22 situation. You have laid down a fiscal consolidation roadmap where we have moved away from the fiscal deficit to debt to GDP ratio. And the target is by 2030, you are going to have 50% plus minus 1%, so 49 to 51%. This fiscal target is 56.1%, which is, we believe, will be marginally higher than that. Now, if we spend now, look, we have to understand, we talked about the wage growth. Ideally, we should not be looking at nominal wage growth, we should be looking at real wage growth. Because if inflation is going by 5%, wages goes up by 5%, in real terms, a consumer remains the same. And if you look at last 2 quarters, what has happened, these are the 2 quarters where you had seen significant decline in the inflation and the real wages, both whether you look at the rural areas and even in the urban areas, has moved up. Urban areas have just crossed in the positive territory. Now, until unless we have a stable real wage growth which remains in positive territory, 1%, 2% or so, that will kick in consumption demand.
Right.
And as of now, no investor, no manufacturer will try to expand capacities when he is looking at idle capacities in the system. And until unless demand remains stable, demand remains stable, we see it's growing, then everybody look at it. Mr. Bagga, like he is looking at it maybe more than I'm looking at economy, right?
Yes.
So I don't know your age, but I have almost the same age group by the gray hairs. We had seen even in 90s, etc. And talk to anyone who was in the DFI, Development Finance Institutions. We used to have IDBI, IFCI, then ICICI.
Yes.
The project's loan was sanctioned when the nominal rate was even 20%.
Right.
Because that was the time when the demand was strong.
True.
So until unless demand revives, it stays where we are right now, 7.5%.
Yes.
You will see the private capex coming in. Otherwise, it won't.
This is a catch-22. There is no taking away from that. But Bipin Sapra, what's the bottom line? Can India afford to play safe in this budget, or does the moment demand bolder choices?
I would go with the bolder choices because it's a very interesting world we are in right now, with geopolitics playing very interesting games out there. Political economy is at its best. How you react at this moment is going to decide where you stand in the whole equation, which is changing, which is dynamically changing. And I'm not a political analyst, as Dr. Pant was saying. So similarly, I won't be an expert on that. But coming to what we have, what the finance minister has on her plate is one thing which she has talked about is customs duties. Tariffs have been what everybody has been talking about, but my push is on the manufacturing side. You look at sectors which need to be pushed and which you need to bet on. There is a whole policy around that which needs to be built in. Mobile phones and the electronics was what PLI really pushed out into. Do we need renewal of that? How do we really keep that momentum going in that sector? Because that's where we have become part of the global value chains, which the National Policy of Electronics 2019 actually envisaged, and which has quite successfully been there.
Yes.
the customs duties on various products, semiconductors, we have bet on in the last couple of years. It's at a point where it will take off and really drive a lot of electronics growth in India. And I think that's one policy success
Sure.
which we should see very soon. But from a customs duty perspective itself, there is a whole lot to be done. And I would really look at what what has to be done. GST 2.0, what it was supposed to do and what is supposed to do and may happen still is to give a lot of money in the hands of people by reducing prices and reducing basically, and that's where the tax collections which have gone down should have gone.
Yes. So, I mean,
yeah, go ahead, please.
No, absolutely. I'm saying that there are arguments on both sides. The argument for caution to protect credibility, to keep deficits in check, to reassure the markets as well. But on the other, you have the case for action, which many of you are articulating, the supporting of demand that needs to happen, the preparation for global shocks. We know that they could be on the anvil, looking at the way things are moving, and ensure that growth does not lose momentum right now is very crucial. So Budget 2026 is not just about numbers. It is about the timing, it is about priorities, and it's about the confidence. When to hold back, when to step ahead. My thanks to Ajay Bagga, Devendra Kumar Pant, Renu Bed Pugalia and Bipin Sapra. Thank you so much for joining us with your insights here on NDTV Profit. Pleasure having your views with us. And that's about all that we could pack into this edition of The Big Question, of course. So until the budget, we are going to keep the discussions moving, and you'll find a lot more of that on our budget programming. But that's for later. For the moment, from me, Vikramosa, and the entire team, thank you for joining us. Good evening.